Trading is about making more than you risk and doing it over and over to get to your goal. It has nothing to do with getting highs and lows. And it certainly has nothing to do with Monday morning quarterbacking and saying, you know, oh, if I had only held. If you're going to look at the stocks afterwards and think that the result justifies the means and that you shouldn't have sold because the stock went higher, you're in for a big surprise. You're in for a rude awakening. And that's going to dictate your emotions, and it's going to dictate your trading. So I learned a long time ago what trading is about, what the goal is. The goal is to make money. It's to make more than I risk and to do it over and over and over and compound a return. And if I'm not looking at just like, someone's richer than me. I'm happy for them, as long as I'm where I want to be.
Risk management is one of the most important things in trading. Risk management is what is going to keep you alive in the market when we're not having good opportunity. A lot of people come into the market every single day expecting to see the same things. And that's not the case. The market goes through seasons. We go through waves. There's times when the market will provide good opportunity. There's times when the market will not provide good opportunity. And it's being able to recognize those things and being able to make the decision to position yourself differently from those ideas.
Now, in your trading, there are things you have control over. There are also things you don't have control over. You have full control over the process. You have control over your perceptions, decisions, and actions. You have control over the way you view the markets. You have control over making a decision to read your trading plan every trading day, forecast and plan, and then you have control over the actions of which trades you take, either according to your plan or not according to your plan. So you have full control over the process. What you don't have control over is you don't have control over the outcome. Whether that trade is a win or whether that trade is a loss, that individual trade's a win or a loss, is out of your hands. There are millions of factors influencing price at any point of time. So it's completely out of our control, the outcome of that individual trade. So what's very important is that you focus on what you have full control over and not worry too much about what's out of your control. And instead of trying to control the outcome of each individual trade, rather it's wiser, and this is what the top 1% of traders do, to focus on sticking to your process and your plan and letting the outcome approximate your edge over 100, if not 1,000 trades. Because if you tie your emotional state to the outcome of each trade, you're going to be run by the market. When you take a win, you're going to be very happy. When you take a loss, you're going to be very sad. When you take a win, very happy. Loss, sad. Win, good. Loss, bad. And what's going to happen is you're now run by something you don't have control over, and you go through the boom and bust cycle. How you feel and how you trade is now dependent on what the market provides to you, as opposed to you standing above that and just sticking to your plan consistently. And if you do that, every single day you can say, all right, I stuck to my trading plan. It's been a good trading day, irrespective of the outcome. I know over a large sample space, I'm going to end up profitable. That's when trading is run by you, and that's how you have consistent profitability. This is boom and bust. This is consistent profitability.
Maybe 2, 3, 4 losses. Bam, bam, bam. And now you're in the hole. Suddenly, out of nowhere, there's an urgency that starts just swelling up in you. And before you know it, you're trying to claw back. You're trying to fight back. You're trying to get those losses back. You want to get back to break even. You're not even thinking about making money now. What you're thinking about, I just need to get to break even. I need to get back to where I was. And meanwhile, you start moving your stops. You do sorts of things. You start making really dumb, stupid decisions about your trading mind and its performance. What just happened? That's one of the biggest problems that I see in trading today, is that guys get pretty good, but when they get into that place where they start taking those losses, and their whole mentality about taking losses and winning and all that stuff really screws around with their trading mind.
1% method. With this approach, traders choose a specific percentage of their trading account to risk per trade. Typically 1 or 2%. The idea here is to stick to this percentage no matter what happens. If you win, your position size gradually increases in relation to your trading account size. However, it's often the case that traders end up losing for various reasons. As a result, they find themselves stuck with smaller position sizes, making it harder for them to make money or even get back to their entry points. Next, we have measuring pips. Now this method focuses on pips gained or lost in each trade. To be honest, This method is a bit ridiculous and I won't spend too much time on it. Trading is all about winning or losing money, not pips or points. So it's essential to keep your central focus on your money, whether it's pounds, yen, dollars, or any other currency. This way, you'll have complete control over your emotions. Last but not least, we have measuring based on R or fixed dollar risk. With this method, traders predefine the maximum amount they are comfortable losing on each trade. They then risk the same fixed amount on all their trades until they decide to make a change. The money at risk is represented as R, where R stands for risk. Rewards are measured as multiples of the risk taken. For example, 2R means the reward should be double the risk. This method requires a fair amount of discretion, but what sets winners apart from losers is their unmatched guts and judgment.
Risk management is so important to get right and to understand right from the very beginning, and that is because trading is by nature very risky. So by now you've probably noticed there are risk warnings on trading videos saying your capital is at risk. So when you are trading CFDs or spread betting, all of the money that you put in could potentially be lost. There are no guarantees with trading.
So the very first rule of risk management for beginner traders is that a stop loss is non-negotiable. So a stop loss is a predetermined point where you are going to be taking your maximum loss. I would say always place the stop loss before you place the trade. So always know where your stop loss is going to be before you even open the trade.
But something that is normal in trading and something that I don't think enough emphasis is put on, especially for those of you that are new to the industry, all you see is people showcasing a very lavish lifestyle and they perhaps never lose and they just win. However, I hate to break it to you, this is just a load of waffle, and a lot of the time it's because they have various different deals with brokerages or whatever it might be. Trying to avoid losses is very unlikely going to get you anywhere. Believe me, I've searched for it. I've searched for the perfection and trying to always validate a loss and remove it in some way, shape or form. But what you'll realise is it is just probabilities playing out, and as long as your system has a good win rate, and if you're above 50% and you have a 1 to 2 risk reward, you will be a profitable trader. You may not be making 10% months, but again, they are very unrealistic to assume you can make 10% every single month. And again, the prop firm industry has led us to believe that's normal.
As a day trader, our main focus should be to stay alive in this game as long as possible. And the only way we can stay alive is by having a proper risk management strategy. Now, a lot of traders, when they get started or that are trading, they focus on what strategies they should focus on, how they should approach the market, how they should chart, and all these other great things. And while these things are great, they're not enough to keep you alive. The only way you'll be able to stay alive and be able to put on more trades is by having capital. And our job is to protect that capital, protect it day in and out, trade by trade. And in order to do that, we need to have a well-defined plan, a well-defined risk management plan that helps us avoid taking too much risk and helps us avoid having too much exposure in trades.